We will now be moving on to the panel discussion, which will focus on container shipping, shifting trade patterns, operational efficiencies, and access to finance, the market outlook for 2021. Moderating the panel is Mr. Kevin Oates, Managing Director at Marine Money Asia. And joining him on the panel is Mr. Bing Chen, President and CEO of Atlas Corporation, Mr. Mats Berglund, CEO of Pacific Basin, Mr. Michael Fitzgerald, Group Deputy Chief Financial Officer at OOCL, and Mr. Jack Shu, Managing Director at Oak Maritime. Before I hand over the floor to Kevin, a couple of ground rules. The audience will all be on mute during this webinar. And to ensure quality control, you should have a control panel which pops up on the right of your screen. There are two actions you can take today. The first is to ask a question. To do this, you simply need to enter your question in the box at the bottom of the control panel where it says questions. I will receive them, and at the end of the webinar, I will ask the questions on your behalf. The second major action is to collapse the menu by clicking on the little arrow on the top of the control panel. So without further ado, I pass the microphone to Kevin to kick off this discussion.
Thank you, Andrew. And thank you, Parash, also for that interesting presentation. And welcome to to Bing, Mats, Michael, and Jack for joining us this morning. Perhaps we'll kick off with just a sort of one or 2 points which Parash mentioned. I mean, he was quite bullish, I would say, about the years ahead. And perhaps we could ask Bing and Michael, who are involved in the container trade. I mean, just a couple of the points that Parash mentioned. The order book is fairly modest. There are numerous older vessels in the fleet, which will likely be scrapped in the next few years. The core competence of China seems to be intact, and freight rates remain fairly resilient. So, I mean, generally speaking, fairly decent outlook. I mean, Michael, to begin with, would you agree with that in terms of your own business?
Yeah, I mean, I think Parash made quite a lot of very fair points there, very reasonable points. And yes, there are some positive signs right now, but I think we are where we are because we've all learned a lot of very hard lessons. 2008, 2009 taught us a lot of things, and in the years after that, there's been a lot of fallout. So the points that Parash mentioned in terms of environmental awareness, in terms of not getting overexcited about profitability and running ahead and ordering lots of ships, are to be added to by the lower level of finance that may be available at certain times in the market. And I think beyond that, in terms of the industry specifically, we have benefited from the wave of consolidation that has really transformed the nature of our sector quite dramatically over a very limited period of time. We are still, Parash is right, we are still a fragmented industry, but we're not as extremely fragmented as we were. And on top of that, I think the tough periods of some of the last 10 years meant that we looked at what COVID was doing to the prospects for the year back in February, March, and we reacted. And the industry simply didn't react in 2008, 2009. We saw collapsing demand forecasts from pretty much everywhere. And in order to manage our costs, we made adjustments. And that kind of rational response is a big positive. So yes, I think Parash is right to say that there are more positive signs looking forward, but there is further along this road to go. We're not at some kind of container shipping nirvana quite yet, but we're heading in the right direction. And I think it's an industry in better shape than it was 5-10 years ago.
Thanks, Michael. And Bing, I mean, your model is a little bit different from Michael's. I mean, how do you tally with what Parash mentioned in his presentation? Bing, I think you're on. You have to unmute yourself.
Okay, can you hear me now?
Yeah, can hear you now. Thank you.
Yeah, I do also share Michael and Parash's view in terms of, what the industry is generally trending to for reasons which I would not repeat that. But looking at from a, owner's perspective, ourselves actually, our own experience speaks for itself. If you're looking at last year, we have the trade war. This year we have, both the geopolitical tension. On top of that, we have this COVID-19. But I think our financial performance, for example, Q1, Q2, we actually, Q1 upgraded our 4-year guidance, and Q2 actually narrowed the guidance to the high end. The reason being that I think in general, as Paresh mentioned and also Mike mentioned, is that the fundamental of the industry has changed, starting from the liners. I think the liners consolidation, really, I think laid the foundation for the sustainability of the industry. And then in the owner space, I think today, as Michael said, I agree that it's still very, very fragmented. Today, even though we have 1.1 million TEU, but we only account for about 8% of the market. So there's a lot of potential to further consolidate that. And the other thing is I think the industry become much more disciplined, a lot less speculation. If you're looking at from the order books, from the demand and supply perspective, and also from a business model standpoint, for ourselves as Seaspan, we in principle, for example, has been always in long-term contract, and with that long-term contract, you will be a lot less exposed to the short-term market volatilities. So in general, I think that it's optimistic, cautiously optimistic, and I believe that as long as the industry continue to be disciplined, I think we should be able to overcome all these difficulties and challenges.
Thank you, thank you. For Jack and for Matt, I have a more general question now. I mean, obviously, COVID-19 is the thing we're all talking about. It's affecting our personal lives, our business lives, shipping, and everything else for that matter. So just a general question. I mean, how has COVID-19 affected your company's operations in terms of onshore and offshore logistics management and operation? I mean, Jack, perhaps you'd like to begin.
Sure, thank you very much. In terms of our logistics and operations, I think it's no secret that every shipping company has experienced the difficulty and change of crew, and that still exists today. We are, in a way, as a company, more fortunate in the sense that most of our crew are from China, and most of our discharging ports are in China. So from a logistical perspective, we just have to manage that, and it's been manageable. But I've heard some other companies having a lot more difficult time than I have, or that my company has.
Thank you, Matt.
Yeah, crew change by far being the biggest operational problem, and it's we have Chinese crews, we have Filipino crews. There was a period when there was no flights in and out of the Philippines. Now it's gotten a little bit better. The Chinese have been extremely difficult to replace in other places than China. So there's been delays, there's been circumstances where we've had to schedule ships to China just to change the crew. Yeah, that's by far the biggest. Otherwise, more problems with inspections, quarantine delays here and there. It's significant, but it's manageable, so to speak. But priority is to get the long-term crew back home to their families.
Yeah, absolutely. So moving on, we heard a little bit from Parash about sort of the economic outlook. And interestingly, in an earlier session we had today, there was a table shown saying that China may be one of the few countries this year with positive economic growth. Most other countries will have from slight to substantial negative economic growth. And I'm just wondering, how this will be translated into a reduction in shipping demand generally. Now, Michael and Bing, you've said that container shipping is basically stacking up, but maybe the worst is still to come in terms of actual slumps in economies and the like. So, I mean, just a couple of comments on that, Michael, perhaps.
I mean, yes, it's been much better than expected so far, but visibility over the next 6 months, 9 months is clearly pretty limited. So there could be the impact of job losses, economic downturns, etc. That could still be ahead of us, and you know, we mustn't get too excited because of it. But in terms of where the drivers for container trade are, I think it's a little bit different to how it is in bulk or in tank, because a lot of the driver for our success or failure is the US consumer, the European consumer, the Australian consumer, who are buying things that are made in China or elsewhere in Asia. So to us, we will be looking as much to those countries as we will be looking to China. But the Chinese data is obviously good because it reflects data there, including manufacturing data, which is a key part of what we'll be doing.
Thank you, Bing.
Yeah, I would like to add is that my view is that in the short term and medium term, it could actually have minimal and maybe even positive in terms of demand. Longer term, I do agree that you know, it's still yet to see, because I think with the increasingly rhetoric in terms of you know, the deglobalization, meaning that a lot of countries talking about moving the supply chain. But the one thing that the reason I'm saying this is long term, because the supply chain change, it will take time and also take the capital. And it's not something that you can change over time. As Paresh mentioned earlier, I think the trade pattern in the short term is going to change, and particularly the way we see is the intra-regional. The trade is going to increase. The mainland trade, as Michael said, it will be, you know, flat or slightly decreasing because of political and also because of economic reasons. However, that decrease in the main trade and also the increase of the intra-regional trade, and also with this migration of, you know, the lower end of the manufacturing function that is moving out of the China to the rest of the Asia. I mean, one example Paresh mentioned earlier, I fully agree, is that, you know, the early stage when China produced $1 import, it will cost $2 $1 export to $2 import, and that will actually create a lot more activities, because let's not forget, for container business, it's all about transporting the goods from one A to B. So you know, it's actually the activity could potentially be increasing. So that's why I think in the short term, medium term, it actually could potentially be, you know, being helpful in increasing the demand. Longer term, we have yet to see.
Yeah, sure. And Mats, I mean, your Pacific Basin have got various robust trade routes that you're, you know, you're extremely strong in. Any sign of these changing or switching, perhaps?
No, that's a very good point, because, you know, currently we have 125 vessels. 125 vessels. You know, we have a utilization rate year to date close to 98%. Even during the height of you know, COVID of March and April, we actually took a delivery of, you know, of 12 vessels. Those are new acquired vessels under the long-term contract. So, you know, on one hand, liners is absolutely much more disciplined, and they do a lot of blank sailing. But on the other hand, the way we have been working with our customers is really work with them in terms of what their trade patterns change, what their needs, what type of vessels they're looking for. What we have seen the trend is that the vessel size is much, you know, our customers looking for larger vessels, usually is about 10,000 TEU vessels. The more, you know, fuel efficient vessels, you know, have more reefers, those type of good vessels. I think it is still in demand because, you know, those are the very diversified. Those are the vessels has the you know, flexibility to be able to deploy to the different trade routes. So you know, from our perspective, we see continued interest from the liners to have you know, interest on these type of large fuel efficient you know, very well spec'd vessels.
Thank you. And Mats, if I can ask you, please, you know, you've built your business on the basis of sort of careful multi-year strategies of growth and technology and efficiency and relationships. And then all of a sudden, you know, the global pandemic comes along, which is completely unexpected and causes a lot of change. how does that affect strategic thinking? And do you think it's just a sort of a hiccup in the long-term plan?
I think it emphasizes the need for a solid balance sheet and liquidity position, and it's just a stark reminder that you have to plan for these unexpected events and cycles. I do think that in minor bulks, you know, the Handysize and Supramax, we are exposed to a much more diverse customer wise. We have a lot of customers, a lot of small customers. We have a much more diverse geographical exposure. Minor bulk is much more evenly spread in the world. And we're also much more evenly spread commodity wise as regards which commodities that we carry. Just because, you know, one specific commodity goes down, we got, you know, 29, 30 other commodities to carry. You asked about changing trading patterns, etc. You know, what in dry bulk, a grain is the most stable one, and that's been very solid this year throughout the pandemic. People have to eat, human beings and animals have to eat regardless of the pandemic, and grain volumes are up, loading volumes are up double digit this year, with Brazil standing out as the exporter and China as the importer. But also very encouraging other dry bulk loading volumes in the last 2-3 months, where both iron ore, that we don't carry that much, but minor bulk has increased significantly. Coal is the negative one this year as a result of lower energy consumption, etc. Specifically, coal into India and Europe has been down. But overall, very encouraging volumes in the last 2-3 months, with China as the big driver of that.
Okay, thank you. I'm going to ask each of you now a sort of individual question about your own company, and if you can just keep your responses to a couple of minutes if you can. Jack, I'll start with you. And I guess, you know, low key, I guess, is the best way to describe it. Maritime, steady fleet of mostly Capes and Panamax bulkers. Do you foresee any change to this sort of family model, which serves so many people so well in various parts of the world?
So first off, with low key and family, yeah, we are relatively low key, even though we do have a public side of it, which is the Sincere Navigation listed in Taiwan. Mm-hmm. In terms of the family model, so just let me explain a little bit. The family model, what I mean by that, as I explained it, is primarily the self-owned tonnage, self-managed tonnage. Overall, our fleet size has been ranged between 15 to 25 over the past 30 some years. We're exposed mostly on the dry bulk, on the larger segment, as well as the crude tanker segment. And over the past 30 some years, we have traditionally delivered one new ship, at least one new ship every year, which basically means for every 2 or 3 years, we've ordered 2 or 3 vessels, with also equivalent amounts of disposal in terms of fleet balance. So the model basically is about actually asset trading. Now, we were able to do so because we were able to finance our vessels, new buildings that is, based on the back of time charters, on average around 5 years. And so on a portfolio approach, we would be disposing those ships that have either paid off in their debts or very low on their debts. In the meantime, with a newer fleet, with a higher amount of leverage, with a fixed time charter cover, that gives us that credit risk, cash flow management risk ability. So yeah. On the whole, though, our last new building delivery was 2018, and that vessel I was actually ordered about 6 years ago. So we were able to stretch out the delivery period of that time because the market obviously was not very good at that time. And so generally
Can I ask you just, you know, in each, let's say, typical 7-year cycle of shipping, can you still pursue that strategy? You know, you buy, you trade, you sell, you buy, you trade, you sell. I mean, it works.
I mean, we've had that huge super cycle in 2009, 7 and 8, and it's a one-time thing, at least in my lifetime. Yes, so there is no real normality in those 7-year cycles, but I guess I'm just being very general, and that's how the model that we've played. Now, the macro environment obviously has changed a lot. There's decarbonization. Obviously, the lifespan assumption of the ship used to be 25, 30 years old, but now definitely 20 or younger. So the risk, the financial risk of new building is in my perspective, extremely high on the back of no time charter cover. So you're basically dealing with spot. So the way I would look at the model is it's broken. I don't think we can continue to play the game that we've had in the past, but given the circumstances of the constraints that we have, I can still see a space for secondhand tonnage acquisition. If we, on average, our fleet age was, let's say, 5, 6 years old 4 or 5 years ago. Now it's pushing 11 to 12. We are in the midst of a harvest season in terms of our overall debt equity balance. So we're happy to continue to hold on to our existing ships and see what the market provides, given that there's very limited new building.
Thank you,
so
Jack.
That's how I look at the model now.
Thank you very much, Jack. Let me ask you, I mean, George Weltman, who is the publisher of Marine Money, recently wrote, Atlas has been single-minded, relentless and disciplined in its approach to deploying capital for value creation, including a specific focus on balance sheet management and liquidity. So can you please just give us a couple of comments about the challenge between deleveraging the company whilst growing the asset base?
Yeah, thank you. For Atlas, first of all, we focusing on not only just the capital allocation, but also all the other aspects in terms of operational excellence and also the strengths of a balance sheet and also the customer partnership. In terms of the capital allocation, the way we see is very critical because in our industry, it's extremely asset heavy. With the asset heavy industry, the investment decisions that you make, it has a significant impact in terms of your balance sheet and also your profitability. The way we've been looking at is that first of all, any type of capital allocation decisions we have to look at is from a shareholder's perspective as to if we how we're going to spend this amount of capital and how we're going to be able to create the long-term sustainable shareholder value. What we have been, I think, successful so far is that to be able to find those proprietary growth opportunities. Specifically here, I'm talking about in the container shipping space. That is demonstrated by the transactions we have done over the past 9 months in terms of looking at those type of second-hand tonnages, where those are relatively young, large, and fuel-efficient vessels that has a demand in the market, where we are able to create those type of transactions, not from a auction type of transactions or purely pursuing for those new build. That is an example of being able to allocate in the capital, continue to meet our rather stringent growth the growth and also return requirement, and being able to I think to serve our customer. That's also very important because we actually deploy every dollar of capital is based on the customer demand. We never speculate. We don't really trade asset per se, rather we operate the assets because we believe that we are the best operators in that industry. We can get the best cash flow out of the assets. So both from the initial investment to the point of the future operations to ensure that we will always meet or exceed our return requirement, and that is the model we continue to pursuing. At the same time, we're looking at the change of the market. If you're looking at Seaspan, 10 years ago we primarily is the new build business. Over the last 3 or 4 years, we never had any new build. Rather, we focusing on second hand because we think that is a good value for capital allocation. And in terms of balance sheet, we are very proud to say that because we have a very high quality of cash flow and predictable cash flow, we were able to allocate these capitals not only for the growth but also continue to continue, for example, to make the dividend distribution. This Actually, last quarter was our 60th consecutive dividend distribution. And also, we are looking at diversifying those, investment opportunities. For example, we recently acquired the APR, which is a mobile power operator business. So we continue to looking for a best way to deploy the capital, creating the value, and that's what our focus.
Yeah, thank you, Bing. It's a very impressive story. Michael, the OOCL acquisition by Costco is now a couple of years behind us. I read recently that OOCL is establishing some new intra-Asian routes. I'm just wondering, if much has changed in the last couple of years in terms of financial management, access to finance, with the new ownership of the company.
I think the whole transaction has gone really very well. The intention was to take the best practices of both sides, from the Costco side, the OOCL side, and to build on both of them within the context of a dual brand strategy. And the dual brand strategy works very well because it allows us not only to have our two different customer bases, but also our two different sets of financing bases. Access to Chinese banks, of course, but also access to international banks, and we all have different networks on both sides. So that aspect has been preserved without stopping us from getting the huge amount of synergy benefits that come along with an M&A transaction. Has the financial management changed? I think we have been able to learn the lessons of both sides. We still show the very traditional old-fashioned OOCL approach of a conservative balance sheet, but we've improved it even further, now being part of a much larger group. So actually our net debt to equity is the lowest in container shipping right now, and we've managed to reduce our debt over the last year by about $600 million. So the company is looking healthier than it ever has. I think one other thing to say in terms of financing, capital investment, is being part of this larger group has enabled us to commit to growing a little bit more comfortably. And now, whether that's in terms of more ships, and we've got 5 large ships on order, 23,000 TEU, or whether that's in terms of making the investment in moving to the next stage in digitalization and technology, these are both important areas for the group to go forward, and it's been much easier to do that as part of a larger group than it would have been to do it as a standalone entity.
Thank you, Michael. Yeah, and Matt, another thing which George Waltman, our publisher, wrote was Pacific Basin's approach to financing is disciplined, focusing on 3 external sources of capital: bank loans, convertible bonds, and equity. As part of their overall financing plan, the company regularly seeks out funding opportunities that are both attractive and beneficial to its shareholders. Can you please give us a couple of comments on this search for the most suitable finance source and how you balance loans, bonds, and equity?
Well, our current net debt to the book value of the ships is about 40%, and we have a KPI never to go above 50. But of that debt, a majority is traditional bank mortgages from traditional shipping banks, which we find the most efficient and attractive. We're borrowing 1.5% over LIBOR or something like that. But we do like one additional layer of debt, and we've been using convertible bonds. Traditionally, we have a long history of successful convertible bonds, and if issued at the right time, we think that is a good alternative to have something other than the traditional bank financing. It obviously comes with some pros and cons. The pros is that it doesn't amortize, it doesn't have any covenants, doesn't have any loan to value covenants, and can be of value in cyclical markets, and a quite attractive coupon. And we've been issuing at a time when the share price have been historically at reasonably high times. We have also been successfully and are very happy about having issued some shares, some equity as payment for secondhand ships to strategic Japanese owners and partners in a very accretive fashion. So we've been issuing shares at a premium to the market price and a premium to NAV. So that's been very accretive way for us to grow. M&A is a bit difficult in our space, and we have been choosing to grow organically, but have been able to issue equity by way of paying for the ships with shares at the right timing.
Mats, can I just follow on? I mean, it's only a few months, obviously, since the onset of COVID, but nonetheless, we've read various stories in the press about some banks being hurt by some sectors more than others, of course. And we've also read that some of the European banks seem to be exiting from some from shipping altogether, but some from Asia as well. I mean, in your discussions with your banks over the last 6 months, have you noticed much change in attitude or in outlook?
Not in our dialogue with the banks. We have no lack of shipping banks that are keen to lend money to us. But I think that trend continues, that some European banks and other banks are withdrawing from the sector. And I think we see more of a flight to quality than we have had in the past. But, you know, our industry in general do not suffer from a lack of financing. If anything, we have too much, right? I mean, we need fewer ships, not more ships. So please don't order more new buildings. And Chinese leasing is the most recent risk to that, right? And the shipyards are using every trick in the book to describe old technology as new technology. Buy secondhand ships for half the price instead, and you know, take out your calculator and don't take that massive residual value risk and technical risk by ordering a ship with a fuel oil engine for delivery 2 years from now.
Absolutely. Jack, I'm not sure which banks you're dealing with, but I mean, have you had any discussions with your banks over the last few months?
No, we haven't. As previously mentioned, our last new building was delivered in 2018. So over the past 3 years or more, we've had no addition, which requires us to have discussions with banks. We are, some of our ships do still have loans, which are traditional mortgage asset-based loans.
Yeah, okay, thank you. And just, we're getting close to time now, but I mean, Bing and Michael, I mean, do you have views on green initiatives and ESGs? I mean, it's obviously, it's a massive issue. We have a New York conference coming up in 2 or 3 weeks from now, which is purely focusing on ESG. And particularly in relation to how these influence and impact the availability and nature of ship finance. Bing?
Yeah, I think for sure it's increasingly the initiatives or focus from both the financing banks as well as from the investors communities. What we have been experiencing with the financing banks today, I think a lot of global financial institutions are really focusing on the Poseidon principles, for example. But these are the initiatives. I think it's good for the industry, and we're absolutely also in the forefront in leading that compliance. From an investor's perspective, they're looking for more and more ESG reporting matrix, which is something actually for Seaspan, for example, we are actually doing those type of monitoring and reporting with our customers. So this is not something that is so different, but we are also in the process of working on these initiatives to provide a much more robust reporting of the ESGs for those investors communities. So in short, I would say that these are the initiatives. Definitely, it's going to continue to become moving up to the priority list for all the industry participants, and I think it's a positive movement. And I think we are actually working closely in continuing to improve in that aspect.
Thank you. And Michael, finally, yourself on ESG and green financing?
Yes, I mean, ESG is obviously getting more and more important by the day, and we would certainly welcome all initiatives coming from any part of the financing markets, debt or equity side, to help that, to incentivize that, to encourage it. But I think that is still very much in formation. There are some very positive developments, and some programs are more ahead of others. But I think certainly for the larger, more corporatized listed entities, you know, we are marching ahead with these kind of measures anyway. We're not waiting to be sort of incentivized to do it. But obviously, if there are interesting schemes to help us along the way, we'll be more than open.
Thank you. So let's just a final question. I mean, obviously, the title of this session includes market outlook for 2021. And maybe it's market outlook, you know, sort of life outlook, whatever it may be. Let's go across the board in just 1 minute each. Mats, please.
I think it's going to get better. I don't think that's an overstatement. So I think the second quarter in dry bulk was a 50-year low as regards freight rates. But again, very encouraging loading volumes, and I'm talking total loading volumes, total dry bulk in the last 2-3 months. We are at increasing levels now year on year. And again, I mentioned the individual cargo commodities and how it looks. And the stimulus activities will be there, I think, to help. The order book is coming down, as Parash showed and some others mentioned. But again, let's not forget that the speed of the dry bulk fleet is 11 to 11.5 knots. We don't need more ships because the ships can easily be at 13 knots, right? So if we can just maintain discipline and not shoot ourselves in the foot by ordering too many ships again, I think we're certainly getting into better and not worse territory ahead.
Thank you, Mats. Jack, your outlook for 21?
So everyone knows in terms of dealing with ship owners that you're not a ship owner unless you actually believe that things are getting better. Whether that's true or not, we know that many times many of us are wrong. But given the context of, I think, geopolitics, we've seen on the dry bulk, the larger segment, we haven't quite seen any kind of sort of a pushing down of the demand. So overall, I think given the fact that with the decarbonization and the sort of the deceleration and almost absence now of new building orders, I think overall it sets the background for any kind of a very finely tuned balance basically between demand and supply. So any kind of a movement will really be rewarded if you were on the right side of the bet. So I basically am optimistic looking forwards.
Thank you, Jack. And Bing, are you also optimistic for 21?
Absolutely. You know, if looking at container sector, as we discussed earlier, I believe that in the next year, we might have some short-term volatilities due to, for example, COVID. That's going to, you know, present some type of, I would say, temporary limitations on a trade. But over a 12-month period of time, and I believe that if we're looking at the general consumption globally, the consumption, as Matt said, people still need to consume, okay? And the supply chain is not going to change. Looking at industry itself from demand and supply perspective, the new order, and I think if looking at the past couple of months' experience, I believe that the industry will continue to be stabilized over the next 12 months with the demand gradually to recover, and in the short term might be some, you know, pockets of volatilities.
Great, thank you. And Michael, you're the fourth to go. Are you the fourth optimist on the panel?
I don't know. I mean, I agree with the general sense of optimism, but I'm maybe, you know, I would add the familiar word cautious to it, because I think the path will be better next year. But the volatility that Bing was mentioning may at times be quite extreme. You know, we don't know what the last quarter of this year will look like, the first quarter of next year, but I think the trend overall will be slightly better because the industry is itself getting healthier.
Thank you. Okay, thank you very much to all of you for a very interesting discussion. And I'm now going to pass back to Andrew, whom I believe has a couple of questions from the audience. Thank you.
Thank you, Kevin, Bing, Matt, Michael, and Jack for that discussion. We have time for one or two questions, but just before I ask the questions from the audience, I would like to ask Bing if it's possible to let us tell us a little bit about Atlas Corporation. I mean, you know, Pacific Basin, OOCL, and Oak Maritime are companies that have existed for a long time and are familiar in the market. So is Seaspan, but recently you went through a rebranding. So let us know a little bit about Atlas Corporation and the ambition of this new brand or new company.
Sure. Atlas is a holding company where we focusing on being the best-in-class asset operator. Meanwhile, we selectively own the assets. Currently, that we own two businesses. One is the Seaspan, which is the world's largest independent, a container ship owner operator, and the other one is actually also the world's largest fast power, generator business, which they use the aircraft turbines to generate in the power. In terms of the group itself, it's two what I will call is the two legs to the stool in a way that allows us to be able to better allocating our capital. At the same time that we can be able to continue to drive the synergy, both the synergy from a cost perspective, because we have a lot of corporate functions that we can share, and also from a revenue perspective, even though these two businesses seems to be in a different sector, but they are both in the infrastructure space. They are both the operating and owned nature. They are both asset intensive, and also they have the relations or indirect relations between maritime and the power. For example, currently we are looking at potentially looking at the floating power generating solutions. So from our perspective, for sure that we're going to continue to focusing on container shipping, which is our core business, and as that's demonstrated over the past months with the continued asset, the capital allocation that we have put it on over the past 8-9 months, is about over $1 billion with about 13 large vessels acquisition. Because I think that with Seaspan's platform, the customer, the fleet, and also the Seaspan's business model, as of now, we continue to maintain a very strong, resilient business model that is long-term contract oriented, where we have today about $4.3 billion of contracted revenue. And that is the path we're going to continue to grow and serving our customer needs. At the same time, with the APR business, I think that's part of the growth initiatives, but both the business are run separately, so they will not be interfering or distracting from what our overall customer service focused approach. And we're going to continue to ensure that we're focusing on these core businesses, meanwhile that we grow with the quality.
Thank you, Bing. So one question that's been asked a couple of times during the session is how will the ending of the tax agreement between the US and Hong Kong affect your operations? You might want to just each of you say one or two words on that. Maybe you can start with Michael.
I think having been in meetings recently with Matt, so I'll probably let Matt speak more about that. But it's something where there is still a lot more detail to come, and we are looking at it very carefully, obviously, with tax advisors in the US and here. And we'll have to see what it looks like in the end. But it could have an impact on operating costs. That's certainly true if there is a freight tax that we end up having to pay. But I know Matt has got plenty to say on this topic.
Matt?
Sorry, I was muted there. Yeah, I don't think there's that much to say yet, because there's still a lot of uncertainties that needs to be clarified. One thing that at least our preliminary analysis tells us is that 2020 will likely not be impacted. So it gives us a little bit of time to research and potentially find solutions. So we're still very much in the fact-finding stage there. But you know, passing this on to customers is not something that we can rely on, right? Because in the spot market, the customer would simply use another ship rather than to use a Hong Kong ship, right? So we got to find a solution to this.
Thanks. And just one final question relating to shifting trade patterns. So the question is, with the expected change in trade patterns, would that have an effect on bunker consumption? Do you think there will be a shift in bunker sales between major bunker hubs? Jack?
Yeah, I think earlier I mentioned on the dry bulk as well as the crude oil segment. Generally, the demand of that has not. Well, crude oil definitely has dropped, but it hasn't created a difficulty in terms of the market, the vessel, the time charter equivalent. As far as the actual question goes, I don't see any net changes overall in the demand supply of bunker as well as prices.
All right. Thank you very much, Jack, for that response. That's all we have time for today. Thank you again to Kevin, Bing, Mats, Michael, and Jack, and also Parash for his presentation in the beginning. Thanks for being with us today. For those of you listening in, this webinar is being recorded and will be posted on our website later today or tomorrow. We'll also send a follow-up email tomorrow with some contact details. So if your question wasn't answered today, you can follow up with our speakers tomorrow. Please note that the next session of today's Virtual Marine Money Hong Kong Conference, session 3, which will be an interview between Kenneth Lam and ship owner Kenneth Koo, will be at 3 p.m. Hong Kong time. So please be sure to register for that session on our website and to join us for that. Thank you all again for tuning in. This is your host, Andrew Oates from Marine Money, signing out.
Thank you.
Thank you.